Hello ladies and gentlemen, welcome to our webinar this Friday. I'm Joseph Novichkov, Senior Trading Manager with GDM. Today's session, ladies and gentlemen, we will start with a brief evaluation of the session we've made this week on Wednesday. Now, what we covered was pretty much everything. We saw how the whole structure of the trading plan works, how we're putting our pre-trade to our post-trade, and of course, most of all, what we've learned is to know when and how to be prepared. All of the significant things that you need to take out and just write down somewhere or review the sessions one more time so you can take all of the important points, and mostly those are the most important rules of the trading and to be a successful trader. This we will start by just mentioning only the topics of them. This without, of course, the unnecessary explanations which we mentioned the last time. So the first one, you have to use money that you can always afford to lose. Second one, do not overtrade. Third, cut your losses short, let your profits run. The next one, if you get into a losing streak, you always have to take a breather. Moving forward to the next rule, this would be building a pyramid when adding to a profitable trade. And this is, for a brief explanation, the reversed pyramid, as we mentioned. This would be always to, if you are adding to a profitable position, to always add a position which is half of the size of your first one, and the third one half the size of the second one, so on and so forth. Number 6, never to add to a losing position. Number 7, don't risk your entire capital on one trade. The next one would be never to meet margin calls. Not at the last place, to remove profits from your account. For all basic traders that have doubts, still trying to figure out the game, they need to start taking profits out of their accounts, at least 1%, the minimum of their profits, so they can secure additional funds for the future. And of course, at the last place, number 10, golden rule, have a game plan. This is our trading plan that we're trying to build and so far successfully implementing into our trading. The structure, however, ladies and gentlemen, we already covered several times during our trading. Today, in this session, what we will do is briefly see what we've done yesterday, how we actually succeeded into our first trading day, let's put it this way, because if you are first day on the market, you have to know where to start from, and as we mentioned the last time, everything matters. The small details from the day before until today when you're executing trades. And today, let's say it's your second day of trading, you're preparing for your new day of trading. You already know what happened yesterday, and what did happen was that we actually saw the US data, as we mentioned. One of the most important tools for any trader would be the economic calendar to monitor all significant events with major volatility expectations. One of these was the personal consumption expenditure prices. Now these pretty much came in line with expectations and the previous, which was 2.2%. Also, we saw a decline with about 3,000 from the consensus on the initial jobless claims and 6,000 lower than previous. Also, we saw that the gross domestic product for the second quarter annualized on the US came about 0.5% higher than the consensus and 0.4% higher than the previous, which is of course just a preliminary report, so don't get too excited. It's just a preliminary report. The actual report comes out next month. Also, we saw the GDP price index, which came higher with 0.1% from previous in consensus, and slightly higher continuing jobless claims, which came out 2.269 million on 2.250 and 256 previous. Also, everything else pretty much came in line with expectations or slightly higher. This is the pending home sales and the core personal consumption expenditures, which are with a medium volatility expectations. But the GDP report, however, brought enough volatility for us to hit a few targets, to make a few good trades. Especially on gold, as you can see here on the chart. This is pretty much when the news came out, where we managed to gain about $8 to successfully trade. Also, this was a couple of days before, actually the day previous, as we can see here at the bottom of 1118, where the major resistance lies, as you can see here. There's a lot of build-up on this resistance place. So from there, we saw the bounce off. And as I mentioned yesterday, whatever profits we made up till the news and its release, from then on, we stayed away from this particular trading tool, trading instrument. Why did I mention that? Is pretty much because of the confirmation that we needed to get here on the 4-hour chart, as the 200 exponential moving average acted as a strong resistance level for the past few days. Also, it needed to be confirmed. When that happened yesterday, later into the US session, we had about $8 up to $9 of decline in gold price, which, as you can see, $800 to $900 of profit on one traded lot. Still, I would pretty much enter the trade right now. When the parabolic starts reversing and I get the signal here from the ADX, that might happen in a couple hours, as well as the 4-hour chart just closed, so we're expecting in an hour or two to give us a bearish signal, so we can manage to enter. However, there is something that it's coming out in about 20 minutes, something that you always have to be prepared, as I mentioned. Here on the calendar, let me just show it to you. Here we go. The calendar here, we're looking at personal spending, also personal consumption expenditures. This is the price index that is coming out, as well as core personal consumption expenditures. You see this, the so-called Tier 2 events are also important, not to be ignored, as well as the personal income. All of this, whether it comes in line with expectations or higher than expected and previous, we can see further downside in gold, also further downside in the GBP USD pair, as well as we've been trading this since yesterday afternoon, as we got the confirmation. This would be the pair that we will be focusing mostly today, as most of the confirmed signals that we're getting is from the pound. Let's have a look at it. That was yesterday here. That was yesterday since the morning when we started trading the pair, when it actually gave us the bearish signal with the parabolics. Also today in the morning we got another bearish signal, which is about 60 to 70 pips in value. That's $600 to $700 per lot. And we're still trading it with the same direction, as we're expecting further decline. You can see the 4-hour chart is not yet done. Still, some retracement is expected before that to 1.5420, 1.5425. where it will meet the moving averages and will give enough resistance for further decline. This will, of course, very much depend on the data that will come out from US, as well as what we saw earlier today. The gross domestic product for UK came in line with expectations, 0.7%, pretty much unchanged, and still the pound resumed its decline, mostly because of the stronger dollar. The expected direction, which is due south, is expected to continue within the next half an hour to an hour, not before a slight retracement, as it's necessary for the trend to be sustained. Still, we're always cautious from the cable. It's highly volatile, especially around news. So we prefer to see the numbers before we start acting on that matter. Most of all, ladies and gentlemen, what we will pretty much follow is the whole game plan, the structure, as we mentioned, which is very simple: pre-trade entry involving take profit and stop loss, what we did during trade, and exiting the market, followed by post-trade, is just the by far basic structure of any trading plan. You can grow any kind of branches around this, extend your rules, or even add more boxes into this particular pyramid, so we can build a better and better plan that suits your trading strategy, your personality, and most of all, how you would like to work with the market. Not the other way around, because if you just let the market work around with you, that would definitely lead to substantial losses, eventually wiping your accounts. So working well with the market means that you need to understand what moves prices. First, we know that fundamentals are shifting every day. That's why we always have to be mindful of that economic calendar, and especially what's up to be announced today. So as we mentioned, today, US announcement in about 15 minutes. We will follow that up along with you to see what exactly the market will be up to. We are expecting some mixed data rather than strictly bullish for the dollar, but still this will result in a liftoff for the US dollar, as well as a lot of investors, should we say majority of investors, believe that this year the Federal Reserve will rise interest rates. So steady upward direction of the US economy is necessary until that happens. And this is, of course, data dependent. Our pre-trade always involves to get familiar, as we mentioned, with what happened yesterday, but still, when we were trading yesterday, we already knew what happened. Now, what we need to see is what happened during the night hours. Nothing major, basically, mostly announcements and numbers from Japan. Nothing major for China, which is pretty much the most important headwind, which could give it any kind of market turmoil. But this continues by choosing precisely the instrument that you will be trading. As well as we can see the GDP report today from UK, also the involvement with additional US data. That means the pound dollar would be the most suitable pair to trade. Why is that? Because we're after volatility. Volatility gives us opportunity. So without volatility, we can't make our profits. On a steady market, trading, let's say, something else like the New Zealand dollar against the Australian dollar, that is a currency pair that is always volatile because it's an exotic. And exotics are usually extremely volatile. But if you take, for example, the Swiss franc versus the US dollar, now that wouldn't make much of a move before the announcement of US data. And what we need is that volatility in the European session and in the US session, depending on our time zone and the way we can trade that. So first of all, we got the data. It's rather bullish for the pound, but still not much of a significant change, especially in the GDP. If it was at least 0.1% higher, now that would have been extremely different. Now then we would have seen 100 to 150 pips up movement in the pound, but that of course would be capped, limited due to the release of today's data, because any data that comes from US is significant. It is not to be underestimated. It doesn't matter if it's with low volatility expectations or high volatility expectations, it's still important for the final goal, when to raise interest rates. And that's how we choose what to trade today. Now, how we trade it, now that would of course depend strictly on your system. The one that I use is the same that I used yesterday, the one that I used for the past 6 months. So it works quite good for me. It gives me quite accurate and often pretty good signals. You can see this is a move on 26th of August, 2 days ago. The bullish pattern, the bearish divergence here just appeared high on this sideways range. Still, we got a confirmation on the bottom of this range, somewhere around these small dojis here with the parabolic, which is still bearish, but the best move we got when we had a crossover of the ADX, and of course it breached above the 20 level. So our entry point was over here. And of course we got an exit when the ADX reached 27 or a little bit higher. We usually exit on 27, which was over here. It's about 200 pips in direction of the pound. Since then, it just made sideways direction. As we can see, the volatility started dropping until the new signal this morning when the price, when the ADX breached again above the 20 level with current profit about 50 to 60 pips. And we're still bearish, but we're waiting for the news to come out because we're just about 10 minutes away from it. And we want to be sure that we're not going to be on the bad side of the market. So what we did during our trade was getting informed by various news agencies of what they think about the US economy and at the same time of the UK economy, because you see both of the economies are moving along. So we're expecting UK to raise interest rates since the first time since 2006, right after the US, a couple of months after. That means in the first quarter of 2016, which is by far quite close. So even if the Fed raise interest rates in October or November in their meetings, that means UK will be moving strictly with it. For a very simple reason, they do not want to devaluate their own currency that much, you know, according to the US currency and any other currency. So stable cable is the best word to explain the pound dollar. That's why we've been focusing so much on the cable for the past few months, because it's been stable. It's been mostly trading in a range, but when it breaks off from a range, we can expect very good results. up to 100 to 150 pips in move for one day, which is pretty good. And while it's trading in that particular range, it rarely gives, let's say, possibility for error, because it is stable on the sidelines. So even if it breaks off from this range and we made some kind of a mistake to stay in that trade, for those that decide to wait until it reverses, they're not going to wait that long, based on the fact that both currencies are very strong, and they tend to be moving mostly sideways rather than in a directional trend. So what we see in the recent moves of the decline of the pound, that's mostly of the strength of the dollar. Because UK economy is blooming, everything is going good, with very small exceptions of the housing market, which is a delaying indicator, as we know, of inflation, which pretty much hits right now for what happened in the beginning of the year. And it's pretty much the same with the US. So it is very important to assess the numbers very carefully if you are focusing on a longer term trades, especially from an investment point of view. According to that, most people tend to make a lot of mistakes because they think that day-to-day data matters for the long run, like a GDP report right now that comes bad, let's say. That's not necessarily the case. Next month it could be better. But you see, quarter-on-quarter reports are just a fragment of what is happening on an annual basis, which is by far the most important piece of information for any country and any government to evaluate its own performance. Exiting the market is the final piece of the puzzle that we need to do before starting to relax ourselves. Now, I exited today's trade a few hours before the release of the data that we're expecting in about 5 minutes time, 6 to be more accurate. So what I did is to protect my investments, to protect my own funds from any kind of spikes, any irrational trading that might come to mind, you see, because let's take a look at gold chart, for example. I'm going to give you a few examples here. You see, on this particular hour trade, okay, you know, I haven't been trading gold this today because I'm waiting for the news, but if you are in the trade since yesterday, the short trade, and you're still not out of it, you know, you still got a chance to get out, simply because we're at the resistance level of the 200 exponential. It's hovering around it on the 4-hour chart. You can see it here. Let's see how close it is. So when the price is that close to 200 exponential, we rarely take action. Now we want to see it somewhere over here, probably even below 1117, so we can take action for the bearish indicators to start confirming. Then we will have at least you know, $5 to $8 away from that particular moving average, which will save us a lot of pain in the future, because the further away from the exponential moving average, the higher chance of a continuation of this trend is. No matter if you have any kind of crossovers like this one. So you see, this could just be a sideways direction when moving averages are not that accurate, or let's say not used to trade directional sideways directions at all. Exiting the market on the pound, however, was strictly strategical because of the data that I'm expecting. No matter that it's tier 2 event, no matter that it's medium volatility expectations, you see, most important thing to remember here is that every pip matters. This is your own profit. So when this signal occurred, I've entered over here on the second parabolic, and I exited over here when I just saw that this particular candle is very close to the middle of the previous session. Just a few pips below the middle closed, which is close enough for me to sound the alarm that something is definitely wrong. We didn't see a close below the previous session's low, which you can see those two large candles. Some call it harami, some call it something else. So 1.5370 was a very good level, a strong support level here. So I didn't see a sustained trading after the breach over here. That's why I exited on the next possible as close as possible level to that support. And no matter if the price breaks it and confirms it in the next few hours, that would only make me even happier, because if I was greedy enough to stay into that trade, I was going to be right. But what happens if I was wrong? Then I would tend to lose money, of course. But in that case, I was going to be still happy because I exited the trade and booked my profits because of the data that we're expecting. And there is no single piece of information that it's insignificant. So please remember, ladies and gentlemen, everything that you see in the calendar is important enough to move the market. With just a few pips or with just a few hundred pips. But it just moves the market enough for us to make profits or to hit stop loss. That's why we should never be greedy. Now, this is the place where I would pretty much, let's say, speak about a mistake that I've made, which I do not regret, of course. I lost $1,360 precisely on an oil trade because I was on the way home, not yesterday, the day before. I saw the news that came about 5.5 million barrels a decline in stockpiles. I was sure that the price will pick up. Of course, on such an event, there is no other choice what the price would do. What happened was that the price shot up about 15 cents. I was on a $2,100 profit that day on this 15 cents. And I didn't take it. I just scalped the market, but I didn't take the profit. I thought it's going to continue going with at least 50 cents to 60, 70 cents. You see, that was a profit I was ready to take. It didn't happen that way. Instead, the market went down for a very simple reason, because stupid news agencies said just because gasoline distillates climbed, the oil should fall down. That's absolutely ridiculous. Oil price depends on the oil itself, not the distillates, the gasoline stockpiles. Now this is ready to be consumed by the end party, and they weren't so large. So what happened is, I'm going to show you on the chart. This was the mistake that I made. Actually, it wasn't a mistake. I was right about the direction, but my timing was terrible, or should I say, I was impatient to close my position prior to the profit itself. So have a look. This is for our chart. This is the low here. 26th is over here. Exactly on this candlestick, I've entered over here. It was somewhere around 39, 45, something like that. The market shot up to, let me zoom it in for you to see better. Okay, I've opened it somewhere here, and somewhere over here was when I noticed that the market was making me money on this shadow here. You see, Then, same day, market went down with about $1. Now this is a price of 38.50. I waited for the price to retrace to close to 39. Okay, so I closed it. I closed that deal with a loss of, as I mentioned, about $1,360. It's not a big loss. Still, my regret was that was the lowest for the day, and the market reversed same morning with about $3 to $4 to the upside. Now this would have been about $4,000 of profit on one lot, and the size that I've been trading would have resulted with more than $12,000 of profit. So you see, my regret was that I didn't trust myself this day. Instead, I wanted to have a peace of mind when I went to bed. That's why I closed my position. And I didn't open a new one in the morning because I was preoccupied with gold and significant moves that it made. Still, my profits went in right with expectations because gold was extremely volatile these days. So the only thing I regretted was that I was right about this particular move. I was right about the direction as usual, but I was impatient and I needed that peace of mind to sleep well tonight instead of just getting up 3 a.m. To look out at how exactly the market opened during the Asian session and how much money I would be able to lose. That's not who I am. So still, there was something for me to learn out of all this. Whatever that you do, if you're close to your ending day of your trade, do not open more positions because that's only going to prolong your trading day and you will get very exhausted. That's what I did. I saw the news and it was, at the end of my trading day, it was like a couple of minutes off, even though I was anxious to see because I was predicting this particular move. It's just a retracement, don't get me wrong. It's nothing like a direction of the oil price or whatever. But I even spoke to one of my colleagues on Tuesday this week. He was like, gold is performing quite all right, is strengthening a little bit. Still, what do you think is going to happen with oil prices? Well, I told him we're probably going to see prices above $40 a barrel this week, especially the move might start even on early Wednesday before the announcements, but it actually started on early Thursday. So you see, that particular timing didn't make me absolutely wrong, but just impatient enough to close a position which would have made me very profitable on that particular day. But the thing that it's most important for us all to remember here is that we should never regret what happened, only to look forward and to learn from our mistakes. So what I learned this day was to always trust my judgment. Well, enough with examples. That was actually the mistake I made. The first one for about a month and a half, something like that, if I am not mistaken. One of these was on the dollar-yen a month and a half ago. I was even in vacation back then, but still, it doesn't matter. Profits are flowing in. The only thing we need always to squeeze out of this is why we're making our positions, to record everything on a piece of paper. You have it as a future reference, and when we're making losses, why we've made those losses. And as this example I just gave you from 2 days ago, it has since then stuck pinned on my monitor to see what I've done and to always remember to trust my own judgment. And this is what you always should do. Trust your own judgment, especially there is something that I've noticed long ago. Whatever you decide early in the morning, when you wake up, your brain is much more fresh. It thinks absolutely clear. It knows what to filter and what not. So whatever decision you made then will be by far as close as you can get to the real deal, to the truth, than the decision that you will make in the afternoon. So if you decided to buy something in the morning, stick with that. Well, ladies and gentlemen, I'm not going to stay too long with you today, as it's Friday, as also close to the end of the month. There is a lot of contracts that are expiring. So first of all, I would like to take a look at the economic calendar with you here. Let me just refresh it, see what we have. A bit of a negative news with a bit of a positive news as well. As I told you, we're expecting a bit of a mixed data today. Personal spending is pretty much with the same as the previous month. That's 0.3%. The consensus was 0.4%. Not major difference or nothing bad at all. We have personal consumption expenditure price index comes down 0.1% from previous, and pretty much everything else comes in line with the core personal consumption expenditures 0.1% in the red territory from the previous year-on-year, which is the more significant indicator at this stage. And the month-on-month is in line with expectations and previous as well. So as I mentioned, the data was mixed as well as we expected. Of course, there is the event that is pretty much the most important event this week. That's why the markets are eager to close early today, or should I say traders to get out of the market early today. It's the Jackson Hole Symposium. This is where the Federal Open Market Committee actually meets. It's an open symposium. They discuss various things, let's put it this way, from health insurances, if you want, to federal interest rate increase. So everything that it matters will be discussed there. It's not a final decision, but still we can always look for some clues. And as well as the market is closed on Saturday, we can pretty much take some notes for the trade that it's going to be on Monday and Tuesday. And for those that are from UK, please remember, on Monday is a holiday for UK, so probably most of you will not be around on the market. So whatever positions you have today, my advice, attend to them, close them appropriately. Don't leave them when you are not going to be in front of your monitors and you will be celebrating. So because Tuesday, 1st of September, it might be too late for you to close those positions, especially what we're expecting tomorrow in the symposium at Jackson Hole. That's all for today from me. Thank you very much for joining us. Whatever questions you might have, you know always how to address them. And for new strategies that we're actually right now developing, it will take some time to put them into webinar, but as some of you might already noticed, as we spoke a couple of times, the strategies that we're actually developing at this stage are quite interesting. There are a lot of people that are anxious to see it in an open session. For those that are traders here at the firm, they already have been blessed by receiving some heads up on these strategies to use them in particular. For those that are not, you know how to to find us through our support department, so you can get in touch and we can talk a little bit more and discuss your case. That's all for today. Have a beautiful weekend, everyone, and I'll see you next time in our sessions. For those that already have arranged one-on-one sessions with me, I'll see you next week. Thanks all for joining us. See you next time. Bye-bye.